We're very pleased to have Nikhil Shah, Managing Director at Alvarez and Marsal, joining us in our Mumbai studio. Many thanks for joining us, and we've talked about the potential and scope for private asset reconstruction companies here in India. But I wanted to focus specifically on the banking system and the bad assets there and the multiple approaches that may be needed to solve the problem. We're also going to draw up some data on the screen that we're sourcing from Alvarez and Marsal. Let's get straight to it. A public sector asset rehabilitation agency. How does that sound to you? Does it sound like a viable sort of step?
Thanks for having me on the show, Manvi. I would like to actually just frame the problem to start off with. I think that currently we have about $180 billion, according to the latest economic survey, of stressed assets in the Indian banking system. This is at sort of an all-time high, and it has actually grown by about 600% in the last 5 or 6 years. Now, the problem actually is concentrated in largely public sector banks and some of the larger private sector banks. And the solution to this problem needs a sort of multitude of mechanisms to be available, one of which the government and the Reserve Bank are considering, which is looking at setting up an asset management company or bad bank that could acquire these loans in a coordinated manner and then try and work them out, restructure or sell or liquidate some of those positions and try and drive recoveries in those accounts. So I think some of the considerations that need to be taken into account for this are, one, is it a mandatory or voluntary process for banks to participate in selling these positions? Secondly, at what price should they sell these positions, and who determines that price? The impact of the price, actually, if it's done at a price that's lower than the book value that the banks are carrying these loans at, implies that there's going to be a haircut or an impairment that the banks will have to take, which will lead to them requiring to raise capital. And in the public sector banks, that clearly means that the government will have to contribute that capital to those banks if they want to retain their majority shareholding in those institutions, which they have made through public statements repeatedly. So which actually translates into a large amount of capital that the government will have to look at infusing into the banks to recapitalize them. And the last issue I think that's at play really is that even if these assets are sold to a bad bank or asset management company, they still have to actually be restructured or sold, or essentially worked out, so that the value is retained and not destroyed through this process.
You know, you've listed some of the key issues, and it was valuable for you to sort of frame the discussion at the outset. I mean, what is the way out? Because based on what you've just described, it could be a case of sort of the government going around in circles because of its, caution in capitalizing banks very aggressively. So, I mean, what would you recommend when it comes to, and again, some of these questions are unfair, but, mandatory versus voluntary, pricing, how do you go about determining the pricing? There's always the comptroller and auditor general overhang for many public sector units when they're operating. So what's the way forward according to you?
So I think that in my mind, actually, there are sort of three things that are affecting the resolution of these assets. One is the valuation gap, which exists. So most of the banks are carrying it at a certain value, the book value, whereas the market value of these loans is far lower. So which implies that there's a hit or provisioning that the banks will have to take as a result. The second issue is related to whether the banks, in particular the public sector banks, are willing to take those haircuts, and even if they are willing, are they willing to be investigated for those decisions that they've taken in terms of the size of the haircut or which companies they decided to provide the haircut to? And this is a very real issue that most of the public sector banks are facing right now, given what has happened with IDBI and Kingfisher Airlines, where some of the senior management of IDBI were arrested on allegations of impropriety related to Kingfisher Airlines, which was a stressed account. And so there isn't any incentive for individual public sector bankers to actually try and resolve these situations. Because they would more than likely be investigated subsequently.
Okay.
The third issue, I think, that is driving it is really that there's sort of not a forcing mechanism in place that takes along the promoters and equity holders in these situations. And so without providing a forcing mechanism, it's very difficult to get them to agree to cede control or agree to a change of control where their share value is diminished largely.
Is this a good time to sort of evaluate how the RBI's mechanisms have worked or haven't worked when it comes to stressed assets, whether it's SDR, whether it's sustainable structuring of stressed assets? Just your thoughts on how that is playing out.
Sure. I think that the RBI has tried to come out with several tools and mechanisms to try and allow the banks to address this issue. I think that if you take each one individually, let's take the SDR, strategic debt restructuring, which is effectively allowing banks to convert part of their loans into equity with the objective of selling those companies to try and recover their dues. This is largely, again, not worked, I think, primarily because out of the 35, 40 companies that have publicly announced an SDR mechanism, invoking an SDR mechanism, only 3 or 4 of them have actually converted the loans into equity. That has only taken place in those companies primarily because those boards of those companies and the equity holders and the promoters have agreed to allow that to take place. The RBI regulates banks and financial institutions in India, and it cannot force promoters and equity holders to go along with this if they don't believe that that's the right solution for them. So again, coming back to, I think, the same issues that I had highlighted to you. The S4A, I think, was the sustainable debt restructuring mechanism come up by the RBI. Actually has faced a different problem, which is that even allowing 50% of the loans to be written off, we're finding that the underlying companies where the loans have been provided are not able to still service the remaining loans because there's no change in the repayment schedule or the interest rates of these loans. And so even with a 50% reduction, the companies are not qualified to actually or eligible for this mechanism.
You know, so it seems like there is this $180 billion problem and not very much seems to be working. If you had to look for, cues on what could work or signs of it working out, what examples would you share?
Well, I think that there are some good examples of governments and central banks in other countries actually setting up bad banks. An example of that is Ireland. We actually A&M advised the Irish government and central bank on actually setting up their asset management company to acquire these loans. The loans actually were transferred at 57% discount to the book value, and then were actually sold subsequently in a 7-8 year period. And a lot of value was actually retained by the banks as well as the asset management company that actually was a specialist in this area. So I think that there are examples of bad banks actually working, including very large-scale one like TARP in the U.S. I think that it needs to be considered carefully relative to what we have in the Indian context. most of those loans in other markets were real estate oriented. And here in India, the stress is actually in sectors like steel and power and infrastructure and textiles, which is driving about 60-70% of it. So I think that we need to be careful about actually creating a bad bank type of solution. I think a far more realistic or practical way of doing it is actually what we have with the Insolvency and Bankruptcy Code, which became operational in December. That has got its own set of challenges, but I think that it's a sound mechanism which should allow for creditors to recover dues in these cases and try and address this problem in an organized fashion. I think that the challenges it's facing currently are related to sort of adequate infrastructure in place and whether there's enough judges that are trained in the new bankruptcy system. And I think there are obviously precedent judgments that need to come about because the law is new and it's being sort of subject to interpretation issues.
Well, I'm glad we could sort of hold some hope out at the end of our conversation today. Here's a direct question. You can choose whether or not to answer it. Has the government sort of been in conversation with you, your specialists in this business, to try and get the principles for a potential bad bank in place?
So we haven't been in touch with the government specifically related to setting up of a bad bank, but we have been in touch with the government and various ministries for both the bankruptcy and insolvency code and as well as specific assets which are being restructured.
Okay, Nikhil Shah, appreciate that straightforward answer. Good to talk to you, and we look forward to having these conversations more frequently because, as you said, it's a $180 billion issue. It needs to be tracked.
Thanks, Manvi.
Thank you.